Ladies and gentlemen, good day and welcome to the Q3 and 9 months FY22 earnings conference call of Saphhire Foods India Limited, organized by Orient Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Kapoor, Head of Investor Relations. Thank you, and over to you, Mr. Kapoor.
Thank you, Margaret. Good afternoon, everyone, and a warm welcome to quarterly FY22 earning conference call of Saphhire Foods India Limited. I am Rahul Kapoor from Saphhire Foods Investor Relations team. I hope everyone on this call and their loved ones are keeping safe in these testing times. On this call, I've been joined by Mr. Sanjay Purohit, who is CEO and whole-time director of Saphhire Foods India, our CFO, Mr. Vijay Jain, and our investor relation partners, Orient Capital. We have already uploaded our investor presentation and earnings press release on the stock exchanges and our company's website. I hope you have got a chance to look at those documents. We'll initiate this call with the management commentary, which will be followed by an adequate session of question and answers. This call may contain some of the forward-looking statements about Saphhire Foods, which are completely based upon our beliefs, opinion, and expectation of Saphhire Foods as of today. These statements are not a guarantee of our future performance and involve risk and uncertainties that we cannot foresee today. With this, I'll hand over the call to both Sanjay and Vijay so that they could enlighten us with our Q3 highlights and some of our recent achievements. Thank you. Here you go, Sanjay and Vijay.
Good afternoon, everybody. My name is Sanjay Purohit, and first, thank you for attending our first investor conference call to announce our financial results post the public listing of Saphhire Foods in November 21. I'd like to thank all our investors and stakeholders for supporting the company during the IPO process, and we look forward to a really long and productive relationship. And our shareholders include some marquee names, foreign institutional investors, insurance companies, mutual funds, domestic financial institutions. We are very grateful to all of you all. We've delivered our best ever performance in quarter 3 of FY22, and this is a reflection of the Saphhire story that I'll reiterate in a little while. During the financial year, we have continued to bear the brunt of COVID-19 disruptions. While consumer sentiment has always been very positive and buoyant and improving, our operating conditions have fluctuated between quarter 1, quarter 2, and quarter 3. However, we've been able to build an operational framework to minimize our downsides and then recover quickly as our business environment improves. And really so has been the case in quarter 3 FY22. If I look at the last 8 quarters since the start of the COVID-19 pandemic in quarter 4 FY20 in March, this quarter has seen actually the least number of operational disruptions relatively. So while our delivery sales has continued to grow, our dine-in sales have recovered, albeit still at a 75 to 80% of pre-COVID FY20 levels. And as a result, our omni-channel strategy and the business has had its best ever quarter. So I'm really happy to say that we've delivered our highest ever quarterly sales, our highest ever quarterly EBITDA margin, our highest ever PAT numbers, and finally we have opened more stores than ever before. As we speak, I think the third wave of COVID pandemic has again resulted in some disruption starting end of December, and our operating hours in January and February and some channels have got somewhat disrupted. But I must strongly emphasize here that I believe in the resilience that Saphhire Foods has managed to build. The long-term prospects of the QSR industry are very positive, and we are confident to be able to mitigate any risks and delivered continued consistent results. I'll move on to, before I talk about the results, I'll just reiterate the Saphhire story, and I'm on slide number 5. We operate restaurants of two of the largest global brands, KFC and Pizza Hut, and in our short operating history, we've been able to build substantial scale in operations and in profitability, and we are among the top 3 QSR operators today. We are a restaurant operator, and we pride ourselves on our execution mindset, exceptional customer experience, and back-end operational capabilities to aid the smooth running of our stores. You've heard me say this before, but we believe in an omni-channel restaurant. What do I mean by this? An omni-channel restaurant is optimized for the best customer experience across dine-in, takeaway, and delivery channels. And we think that this is the only way to make most efficient use of our store assets. Our value-based culture is our strength, allied with our experienced leadership and our management team and our board of directors. And finally, we've built ourselves to be a platform play restaurant operator. And therefore, we've got the necessary requisite capital and the capability to grow both organically and inorganically. Let me move to the consolidated financial summary. In quarter 3 of FY22, our restaurant sales was 505 crores, up 52% over the previous year. Our EBITDA post-Ind AS was 117 crores, up 69% or 23.2%. And on a PAT level, we delivered 10.1%. Like I said, I want to emphasize this. It's our highest ever quarterly restaurant sales. It's our highest ever restaurant EBITDA margin, corporate EBITDA margin, and profitability, PAT profitability. And our restaurant additions at 68 total restaurants was also our highest ever. And all these are compact omni-channel restaurants. Our total restaurant count at the end of December 31st stands at 550 stores. We also have a very strong consolidated balance sheet. Our net cash is about 435 crores and we have negative working capital. You'll be wanting to know what the numbers in brackets in blue and italics mean under the EBITDA numbers and the EBITDA percentage and the PAT percentage number. As a matter of good corporate governance, I want to elaborate on the difference between the two numbers that you see under EBITDA. Every year, we receive incentives from Yum basis the number of restaurant openings we have. This year, due to COVID disruptions, we've received higher number of incentives. As we go forward, these incentives will normalize. And while in this quarter, we have indeed delivered an EBITDA of 23.2%, if we normalize for the incentive going forward, the EBITDA number would have been 21.5%. I want to reiterate, the numbers in black are actually what we have delivered. The numbers in brackets are normalized for the higher incentives that we have received in this quarter. Moving on to the next slide, which is slide number 8. This gives us a very quick snapshot of our current presence. Like I said, 550 restaurants. 250 KFCs in India, 209 Pizza Huts in India, and 89 Pizza Hut Taco Bell in Sri Lanka and in Maldives. Let me request Vijay Jain, who is our CFO, to take us through the specific financial highlights.
Good evening, everyone. Hi, I am Vijay Jain. I will cover consolidated financial highlights from slide 9 onwards. We delivered highest ever restaurant sales in quarter 3 of this financial year at 505 crore, up by 52%. Our gross margin dropped by 40 basis points, still higher than pre-COVID level, and we'll deep dive into each of the businesses to understand this number better. We delivered highest ever restaurant EBITDA at 21.9%, up by 470 basis points. And if you normalize for additional incentive, it's at 20.2%. This is reflection of the performance of each of our businesses. KFC India has delivered highest ever restaurant margin, so is Pizza Hut India, and so has our Sri Lanka Pizza Hut business. And the culmination of all three is what is reflected at a consolidated level in highest ever restaurant EBITDA. Our company adjusted EBITDA, by adjusted EBITDA we mean adjusted for Ind AS 116 lease accounting. So after you consider lease expenses under expense line, we have again delivered highest ever corporate adjusted EBITDA at 16.3%, up by 600 basis points. And if you normalize for the additional incentives, it's at 14.6%, still a very healthy and highest ever number. I would like to bring attention to ESOP impact. Our ESOP impact in quarter 3 was 0.3%. And on the right side of the slide, which are the 9 monthly numbers, you can see the ESOP impact was 2.7%. This is a result of impact which we took in quarter 2, where there was a big chunk of ESOPs which got vested. As a result, the impact on a YTD basis is high at 2.7%. Moving on to the next slide, slide 11, we delivered highest ever company EBITDA, 23.2%, up by 240 basis points. And the normalized company EBITDA is 21.5% after allowing for the incentives. Profit after tax, and some of you would remember the guidance which we gave. We said we'll be PAT profitable in quarter 3. Not only we have delivered PAT profitability, we have delivered highest ever PAT profitability at 10.1%, up by 920 basis points. And if you normalize, it's 8.4%. And not just for the quarter, if you look on YTD basis, 9-month basis, we have turned PAT profitable. So this is a big milestone in the history of Saphhire, where we have turned PAT profitable. Over to you, Sanjay.
So let me just talk to you about the individual brands and how they've recovered. So KFC India has had a really good quarter. From an SSSG perspective, over last year we are about 29% over FY21. And that's really, if you look at the channel recovery rates, and here we are looking at versus FY20.
Slide 14.
Yeah, this is slide number 14. Our delivery sales continues to improve, and now we are at nearly double the levels of pre-COVID. Our takeaway has come back to pre-COVID levels, and dine-in certainly improved, but it's still a little way off from our pre-COVID levels. I've got full confidence that as our operating hours and our channels come back to normal, dine-in will come back strongly. In fact, in the first 2 weeks of December, we had really strong dine-in sales, and then last week, perhaps of December, again, when restrictions were imposed, dine-in had gone down. So, what's working for the brand? First of all, the brand aims to build and expand on mainstream occasions of consumption, and therefore the Aaj Ka Special campaign, trying to get KFC, part of home, has really worked. Also, our entry-level price points, as you can see, the value burgers starting from 69 vegetarian, 79 chicken, have also worked really well. We've had strong digital activation. And then let me move to slide number 17, where we're really excited with this operational initiative of the 7-minute express pickup. This we believe will unlock a new opportunity for the brand. And the simple consumer insight here is that as a result of delivering quicker service, waiting times are reduced, and this fosters greater affinity towards the brand. And today, it's been about 2 to 3 months since we have launched this initiative. We are already having a success rate of over 95% in being able to meet the 7-minute pickup, for dine-in and takeaway consumers. So this is working really well. We've got a few pictures of our new restaurant launches, and really we've tried to give you a mix of the kind of restaurants that we are opening. So KFC Tirupur and Ooty are first time cities where we are seeing KFC for the first time, so they are new city launches. KFC Belapur is our attempt at really densifying Mumbai metropolitan area. So this is a really nice store that has come up in the CBD Belapur area, and we would have perhaps a store about 1.5 kilometers, 2 kilometers in the Seawoods Mall. And then finally Salem is where we have started. Our first store had done really well. We have been operating it for many years, and now we've opened a second store and perhaps a third store quite quickly.
Moving to slide 19, KFC financial performance. In terms of SSSG, we have delivered 29% for the quarter. Our average daily sales, ADS of 144,000 per store average, up by 25%. Highest ever restaurant sales of 303 crore rupees, up by 53%. And restaurant additions of 31 in the quarter 3. KFC gross margins have remained largely stable in spite of the inflationary pressure and challenges. And restaurant EBITDA, we have delivered highest ever at 22.5%. This has been possible on account of two things. One is high throughput, high ADS, and second is continuous focus on throwing out cost efficiencies. The normalized restaurant EBITDA for KFC is at 21.2% after allowing for or normalizing for additional incentives which we have received this year. This is up by 380 basis points. So in all, KFC continues to be a strong performer for us, and we have delivered best ever quarter in terms of financial performance for KFC.
Let me move on to Pizza Hut. Pizza Hut Saphhire also has had a really good quarter. And I think the upside that as dine-in recoveries, our omni-channel stores can give was really demonstrated during this quarter. But before I go ahead, I really want to talk to you about the innovation that we launched recently, the Momo Mia Pizza. I just encourage anyone of you all who is in the vicinity of a Pizza Hut to try this. It's just an outstanding product. It combines both momos as well as pizza. Brilliant product. Try it out. It's done really well for us. And I think this is starting to accelerate the innovation engine also on Pizza Hut. You would have heard me say this in the past. I'm so excited about this brand and what an omni-channel strategy can deliver, on Pizza Hut. Apart from the Momo Mia, so from a channel sales contribution, again, delivery continued to do well. Takeaway also did well. Dine-in came back to about 76% level of sales. And I think even then in quarter 3, I don't think especially the mall stores were back to full capacity. As restrictions ease, I think the full power of our omni-channel strategy will start to play out. A lot of digital activation that we talked about. From a promotions perspective, the brand launched the Dil Khol Ke Delivering campaign, And this is just not to be taken literally that it's a delivery campaign. Really, it's saying that we deliver on great taste or great innovation, great value, great dine-in service, great delivery experience. So this is what you can expect on the brand. I'm moving on to slide number 25 to give you an idea of the new restaurant launches. Again, there is I'm giving you a flavor of the different kind of places where we have launched. So Dharwad and Ooty are new city launches. In Indore, Indore and Trivandrum, we have started to up the intensity of our stores, of our omni-channel stores. So all these stores are doing quite well.
Moving on to Pizza Hut financial performance on slide 26, we delivered SSSG of 22% for the quarter, and our average daily sales went up by 21% to 64,000. Our restaurant sales again delivered highest ever at 113 crores, up by 51%, and we added 21 restaurants during the quarter. Gross margins at 75.4%, pretty healthy, but yes, we are seeing inflationary pressure in Pizza Hut, dropped by 100 basis points. However, in spite of drop in gross margin, we delivered highest ever restaurant EBITDA at 17.3%, and if you normalize it for additional incentives, still at a pretty healthy 14.9%. Overall, up by 610 basis points. This expansion in margin for Pizza Hut was on account of two things. One, high ADS, which is possible because of the omni-channel format which we operate, and the cost efficiencies which have been continued to deliver over the last few years meant that we were able to deliver such a stupendous performance on Pizza Hut. And again, here I would like to reiterate the Pizza Hut story. We have been telling that Pizza Hut is a story of a turnaround, and I would like to reiterate the key pillars on which the Pizza Hut story is based. The first part was the dining experience. We want to retain the dining experience because that's the distinctive identity of the dining experience of Pizza Hut, combined with the competitive value which we offer. And now we are comparable with anybody out there in the market in terms of our pricing, our value strategy, along with omni-channel strategy where you optimize and sweat the sets across all the three channels. And along with our partners meant that we have now improved our delivery significantly. From 30-odd%, now it's around 50-odd% for us. Compact size of the stores, so from a 2,500 square feet stores, what we're opening is 1,200 square feet stores, down by 50%. And the cost efficiencies means that we have a complete turnaround model for Pizza Hut. And while you see the normalized EBITDA at 14.9%, the omni-channel stores which we have been adding, the compact omni-channel stores which we have been adding since April 19, the entire bucket, and I'm not picking and choosing few stores, the entire bucket is delivering margins in high teens for us. So we are super excited about the Pizza Hut prospects going forward.
Moving on to the Sri Lanka business, I must say the country has gone through quite turbulent times, including shortages on foreign exchange and some amount of inflation. But our business there has done just exceptionally well. We continue to be the largest QSR chain in Sri Lanka. Pizza Hut operates an omni-channel format there, and again, this is something that I've said in the past also. Our recovery, so delivery does well, takeaway has done exceptionally well at 172% as compared to FY20, and dine-in there also is slowly recovering, is at about 75% of pre-COVID levels. Great new products launched, the Sri Lankan spicy chicken, popcorn veggie, the Choco Mallow desert pizza. Our digital activation is strong. We've launched new restaurants, highest number of restaurants also, new restaurants we've launched in Sri Lanka. So the Sri Lanka business also is growing very healthily. I think the interesting part here is we were at 2 Taco Bell restaurants for a long period of time. The Taco Bell model also seems to be improving there, and now we are at 5 Taco Bell restaurants. So we've opened, we've opened 3 of them.
Moving to slide 33, Sri Lanka business financial performance. Our SSSG there was super high, 40% for the quarter. ADS grew by 24% at 121,000 rupees in quarter 3. Restaurant sales highest ever again in the quarter at 86 crore rupees, up by 51% quarter on quarter. And as Sanjay said, we added highest ever number of restaurants, 16 in the quarter in Sri Lanka business. Moving on to the next slide, gross margins. Despite the inflationary pressure, we were able to improve the gross margins by 40 basis points and delivered highest ever restaurant EBITDA at 26.4%. And if you normalize for additional incentives, still very high at 23.9%. Overall, the margins were up by 620 basis points for the quarter. So in a nutshell, Sri Lanka continues to be a rockstar performer for us year after year. Have gone through several challenges over the last 3 years, be it political turmoil, bomb blast, COVID, now Forex. But we have come through it more stronger than ever and more profitable than ever.
Let me give you a quick brief on some of the other initiatives that are happening around the organization. We've got a strong ESG agenda, which you can see on slide number 36, you can see that. But I'm going to talk to you about a few of them. What I said, one of the pillars of the Saphhire story is our value-based culture. This year, Saphhire India participated for the first time in the Great Place to Work survey, and we've got certified as a Great Place to Work. They tell me that only 20% of all companies who participate in the for the first time get certified, as a Great Place to Work. So we're quite happy with the outcomes here. Our Sri Lanka business continues to be in the 40 best great places to work in Sri Lanka for the 7th consecutive year. One of the Saphhire values we espouse is that of accountability or personal ownership. If I move on to slide number 38, this ownership we've tried to cultivate as a mindset, but we've also been able to convert it into reality. And when we've issued ESOPs to about 1,000 employees, including our restaurant managers and our subsidiaries, both at the corporate level as well as the restaurant managers here. It's quite quite unique and different, at least in the industries that we operate in. Our diversity and inclusiveness agenda again is strong. We've got about 150 specially abled employees across both brands. Economic Times recognized Saphhire as the best workplace for women, and we've now got our first all women restaurant at KFC R City Mall in Mumbai. That's the story. Again, in the end, I just must repeat how excited I am about the future. We are a public listed company. The whole QSR industry is seeing very good growth. And Saphhire Foods, with our strengths, I'm quite confident in our prospects going forward. I'll stop here. We will now open the session up for questions and answers. For questions, rather.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, good evening everyone. Am I audible?
Very audible, Percy. How are you?
I'm fine, thank you. Apologies for the noise here. There's some construction going on. My first question is on trying to understand your seasonality. So both on the top line as well as the margins. So firstly, on the top line, could you give me an idea in a normal year, first of all? Let's forget all the COVID disruptions in a normalized year. The Q3 ADS would be what percentage higher than the annual ADS? And similarly, the Q3 EBITDA margin would be how many basis points higher than the annualized EBITDA margin?
Thanks, Percy, for the question. So again, very difficult to put an exact number to it, considering that quarter 3 is full of festivities and it depends when the Navratra starts. The Shraddh starts in quarter 2. At times it falls in quarter 2. At times it falls in quarter 3. It ends again with the Christmas. Again, this year by Christmas, there was a COVID wave 3 impact. So it's very difficult to put the exact number to it. But typically, quarter 3 revenue would form anywhere between 25 to 28% of our overall revenue. In terms of EBITDA margins, they range anywhere between 100 to 200 basis points higher for quarter 3. This would be in line with the industry practices. I think industry would also observe a similar trend. But very difficult to put whether this quarter was higher by that amount or not due to several restrictions on account of COVID and the impact which we had on last 15 days of December.
Very pleased to note that margins have climbed up very sort of respectively. In fact, in KFC, your restaurant operating margin is now in excess of 20%. So just wanted to understand whether, I mean, is there any upside to these margins? Of course, seasonally adjusted, but is there any upside to these margins, or you would be comfortable with these margins at this level now?
So Percy, again, as the organization, if you see our last 2 years track record or 3 years track record when we came out during the IPO, every year we have been able to generate margin upsides both in KFC, Pizza Hut at a corporate level, year after year. In fact, the margin expansion which we have delivered over last 2 years has been highest ever by any player in the industry. But putting any specific number to a particular brand, I think would be very difficult. All we can say is that we continue to really work on the programs internally, very strong programs on delivering margin efficiencies. As we move forward, we'll continue to see higher margin growth and EBITDA growth compared to revenue growth.
Okay. And if I just...
Yeah, Percy,
sorry, please continue.
I guess at the stage that we are in, KFC is doing really well, really strongly. 6 years ago, this was in the markets that we handled. So when we acquired this business, this was delivering 6%. This is the kind of growth that we have seen over the last 6 years, or we have delivered here. If you ask me, I'd rather push for growth at this stage rather than, and then margins will accrue as a result of our economies of scale and as a result of our expansion.
So if I just ask the question slightly differently, rather than focusing on the margin, let's focus on the inputs. In the last 2-3 years, you've made some specific changes in terms of the restaurant size, full-time versus part-time employees, etc. Now, all these initiatives are already in place. Are there any other initiatives which have not been rolled out to all stores, or any initiatives which you have just thought about and yet to implement, which could be margin drivers in the future?
So, Percy, in fact, one thing I would like to highlight is about our internal program, which we call it as Pace Setter program. A very simple but difficult to execute program. Here we bucket the stores basis their revenue. A similar revenue stores are getting bucketed. So a bucket of 10 stores or 20 stores with a similar revenue. The top performing store on a particular parameter, it can be either labor hours, it can be electricity unit consumption, be it wastage or gas cylinder consumption, are compared with the rest of the bucket, and learnings understood from the top performing store, and the rest of the stores are invited to replicate that best practice. So this is a continuous program. You will always have a top performing store in a bucket of 15 and 20 stores. So there is never an end to margin efficiency by that logic. But yes, the pace of margin expansion, what we have seen previously, as you move forward, continuously it will be lower, but there is always an opportunity.
Right, got you. And finally, on store expansion plans, can you give some idea?
So Percy, we came out with a guidance, I think few weeks back, where we said while we'll end the December quarter around 540 odd stores, we actually ended at 550 stores. and we said that we will double our stores over 3 to 4 years across KFC, Pizza Hut, and our Sri Lanka business. We'll stick by that guidance, doubling the store count over 3 to 4 years.
Okay. I'll come back in the queue if I have more questions. Thank you.
Thank you.
Thank you, Percy.
Thank you. The next question is from the line of Utkarsh Maheshwari from Reliance General Insurance. Please go ahead.
Good afternoon, sir. Congratulations for a great quarter.
Thank you.
Thank you.
Thank you.
As we have seen that the dining has a little bit picked up, and probably I think in Q1 again, for the current quarter again, we have seen some impact because of the virus and all. So we have already mentioned that there is a possibility of some margin expansion because I think the peers are already there at that higher level of margin. So probably the kind of pace what we have seen in Q3, could there be some moderation in Q4 because of the factors what we are already aware?
You are talking about moderation in store expansion, or you are talking about So not quite clear, Utkarsh. If you can clarify this a bit more.
Moderation in the growth rates, in the growth possibly, because everything got shut now in January, in the Q4 as such.
Yeah, so your Jan and Feb would certainly be impacted because of the third wave of COVID. Having said that, as Sanjay said in the opening remarks, that our business is resilient enough to take those strides, and within our strides, quarter one was impacted, quarter two was just thereabout. The moment the restrictions go away, the ability of our business and our company to bounce back is reflected in quarter three results. So you will have quarters up and down, but we'll focus on the long-term strategy. Yes, of course, Jan and Feb is impacted. What we're already seeing from Feb second week onwards, that things have started coming back positively for us across all the channels.
Okay. And one more just housekeeping question. This depreciation of 513 million is something which is sustainable kind of number. Though we are expanding, but we are expanding on a store which is on a smaller size. So that's why I think the depreciation number for last year and 9 months and this year 9 months are almost similar kind of thing. So is it fair to just add up a little bit more on this for computing our computations?
So again, depreciation, the way the Ind AS 116 accounting happens, actually the depreciation is combination of the depreciation on the capex
and ROU, yeah.
So a reflection of the lease amount over there. So in terms of a percentage to revenue, I think we are quite comfortable where it lies. Yes, at times the percentage would look lower in a quarter where the revenue is high, but there or thereabouts is the range we are comfortable with.
Okay, fair point. Thanks a lot, sir.
Thank you, Utkarsh.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question at this time. The next question is from the line of Jay Kumar Doshi from Kotak Securities. Please go ahead.
Yeah. Hi, good afternoon. Congratulations for a very good set of numbers, and thank you for very detailed disclosures. We hope you will continue this, going forward as well. Just one quick question. I didn't fully understand this. What is the normalized level of incentive? Now, as per my understanding, you have certain sort of milestone-based incentive arrangement with Yum, and you've exceeded those milestones in terms of store openings, so you got those benefits this year. Now, if you continue to add, similar number of stores next year and year after as well, do these incentives continue, or these were one time in nature, only pertaining to this year?
So again, Jay, over here, over last 2 years, so in calendar year 2022, because the growth phase got impacted during COVID initially in terms of store opening, Yum came up with a special incentive plan, which was other than the normal plan, where we were given higher than usual incentives compared to our previous agreements or compared to our future agreements. So this was not for exceeding the target. is for achieving the target, but incentives were higher than previously what we were getting or higher compared to what we are going to get in the future. So this was in a way during COVID because our business was impacted in terms of revenue and still we wanted to grow our business. You have incentivized us to open higher number of stores, and what we have brought out is the difference probably that going forward our incentives level would drop to this particular extent. Hence we have shown in a good corporate governance manner a normalized EBITDA or normalized PAT.
Understood. Just follow up on that front. So when I look at your 9 months EBITDA for this period, it says 9.6% is the margin and 8.2 is normalized. So 140 basis point was effectively incentive, which was higher than the usual incentive or higher than the incentive that you will get over the next 2-3 years. Is that right?
Perfect.
Oh, okay. And but there will still be some incentives if you exceed milestones in the future as well, right?
Yeah, Jay. So we'll continue to get some incentives in form of marketing, royalty, initial fee waivers. So those combinations continues. It's just that the level of incentives were higher during the COVID year, and it will go down after the COVID gets completed. So it goes down from the calendar year 23 onwards.
Right. From all practical purposes, we should be looking at 14.6% margin in this quarter. And like you mentioned, that margin has a little bit of benefit of seasonality. Very difficult to call out that. But normalized margins, if you were to look at normalized margins with normalized incentives from a full year perspective, it is slightly lower than, will be lower than 14.6.
I would love if you see a 16.3. We have delivered that actually. A lot of hard work into that, Jay. But yes, if from a modeling point of view, you are looking at, probably yes.
No, thank you for calling this out as well, again from a disclosure perspective. Thank you so much and all the best.
Thanks, Jay.
Thank you, Jay.
Thank you. The next question is from the line of Vicky Punjabi from UTI Mutual Fund. Please go ahead.
Hi, thanks for taking my question, sir. I was just looking at the Pizza Hut performance, and when I look at it on a per store basis, I see that and I compare it to say on the pre-pandemic December quarter, which is December 19 quarter, I see that the SG&A per store has at least is marginally lower. I mean, it used to be around 3.5 million. It's down to around 3.3 million. And revenue per store is higher by 16%. So, at 5.4 million. So I just wanted to understand, one is the fact that the fall in this SG&A per store, and again, I am actually using the incentive adjusted.
So not completely clear, so we're missing some words in between. You can go again.
And is there a slide that you are referring to, Vicky? Because it'll be nice to just know the slide that you are referring to.
Okay, no, so I was just, for Pizza Hut, I was just comparing your gross margin versus an EBITDA margin and just taking the balance as the SG&A. So, versus, say for 3Q FY22, your gross margin is 75.4%, and I think EBITDA margin net of incentives is at around 14.9%. So if I just calculate the balance as SG&A and look at it on a per store basis, and I do a similar exercise for 3Q FY20, so on a per store basis, I see that SG&A is actually fallen versus December 19 quarter. I wanted to understand this. Is this a result of any incremental incentives? And this, of course, where I am using the EBITDA margin, I'm using the incentive adjusted margin. So beyond the adjustment that is done, is there any incremental incentive that has been received versus at December 19 quarter, or then on that basis incentives remain the same?
So right now, if you look at 14.9, so once you take 14.9, you have already removed the impact for the incremental incentives, right? So now if you compare 14.9 to 10.2, it's apple to apple comparison. So yes, at that level, we have delivered that kind of a margin expansion. It has happened on two fronts. One, this entire omni-channel strategy, which allows us to optimize the use of assets, has enabled us deliver a high ADS of 64,000. A point to highlight over there is that 64,000 ADS is at a brand level. This is in spite of aggressive store expansion plans, and typically a new store starts at a 20% lower. So in spite of that, we've been able to deliver a high ADS level, combined with efficiencies across all the lines in the P&L, be it labor cost, be it operating cost of the restaurant, be it even rental cost. And rental cost is not a temporary over here. The rental cost efficiencies which we have brought about because of the reduction in the size of the stores, which is from a 2,500 square feet stores to 1,200 square feet stores. And as we keep adding more and more of those stores, your rental as a percentage of sales continues to drop. So that's the reason why we are seeing such a huge margin expansion in Pizza Hut.
I think here we just got to keep in mind, we are still not happy with, we are still not at the full potential of dine-in. So dine-in has still come back to only 75% levels, and it's just the operational issues faced that has resulted in dine-in coming back. Once there are restrictions, there are markets where there have been no restrictions and dine-in has actually come back very, very strongly. So I just want to keep that also in mind, Vicky.
Sure, thanks. No, so this is the other part of my question. I think Vijay answered it partly. That despite a reduction in size of stores and despite addition of incremental stores, or a higher pace of addition of stores, the revenue per store or the ADS has still seen a sharp jump. And what are the factors actually that's helping? Is it largely omni-channel and delivery taking off, or are there something else? Because ideally, a reduction of store size, as well as incremental store addition should have actually impacted the throughputs per store.
Yeah. So let me take that, Vicky. So I think our stores in the past were oversized. There have been, we have economized or we have optimized the store size back end also and in the front end. Front end today, a 1,200 square foot store delivers about 50 seats, which is optimal for us. Again, you've heard me say this, Vicky, and I've used this example, as this is one example. Our Powai store used to have 4,000 square foot, 20 lakhs of rentals. We closed it down in 2015. We opened a 1,377 square foot store, 55 covers. That today does about 45 lakh sales, but it does equally from dine-in, delivery and takeaway. I think this is the power of the omni-channel business, that we are able to deliver the same level of sales because all three channels are optimized. And if you look at it, when we launch in a new city, that we've not been present but the competitor brand is present, people look at Pizza Hut and they appreciate the difference that we provide compared to our principal competitor. And that differentiation is in the dine-in experience and in the product quality. And then when we communicate value that is on par with the industry, and then we've improved our accessibility through delivery, I think that's the power of the model. It's a model that has a relevant competitive advantage in a sense, and offers a differentiation versus our principal competitor.
And again, just to add to that, this reduction in size, as Sanjay said, it's oversized. So while this is delivering a ADS level of 50,000 at a new store or a 64,000 at a brand level, we have not compromised on the capacity to deliver even higher throughput than this level.
Yeah. The same store
can deliver even 50% more throughput. It's completely capable of taking it. So no compromise on the capability or the capacity of the store to deliver higher throughput.
Sure. Thanks. And so if I have to understand, these factors look quite structural in nature. I remember, during the times of the IPO, the margin guidance being 10 to 11%, and that was one of the factors to that was the fact that the incremental or the higher pace of storage addition could really possibly impact the core margin because the newer store started at a lower level in terms of revenue. Now, given the fact that the the execution is kind of better, even in terms of new stores, or the results are kind of better of new store addition. Do we look at upside to that guidance for now?
So Vicky, in fact, for Pizza Hut brand, it's actually reverse for us because in legacy stores we inherited the large size dining focused stores. Some of those stores we still carry. While they're not loss making, the profitability is restricted. They are typically operate at a low double digit kind of a profitability. So more and more new store additions, it actually expands the margin for Pizza Hut. 3 years back, the Pizza Hut margin operated in single digit, 6%, 7%. As we added the omni-channel compact size stores, it moved to high single digit, moved to double digit, now finally has moved into teens. So the more and more new store addition, which is our compact format omni-channel, will actually expand the margin for Pizza Hut. The story for, you're right. If you actually add more stores, we will actually expand the margin.
Okay, sure. Thanks a lot, and congrats for the strong results, sir.
Thank you so much.
Thanks.
Thank you. The next question is from the line of Shirish Pardeshi from Centrum Capital. Please go ahead.
Hi, Sanjay. Good evening. Thanks for the opportunity and congratulations.
Sorry to interrupt you, Shirish. Your audio is quite low. May I request you to come closer to the phone and speak a bit louder?
Audible now?
Yes, better, Shirish. How are you?
Hi, Sanjay. Good evening. Thanks for the opportunity. Congratulations. There are 2-3 things which I wanted to have a clarification. When I look at your store count last year versus this year, December, we've added 125 stores. While we also see there is a heightened focus by the competition and there is a whole consolidation happening in the front end. Do you think this store guidance, what you have said, doubling the stores in next 2-3 years, you will fast forward in next, say, 2 to 3 quarters?
No, so we have said we will double the store count in 3 to 4 years. We hold that. We hold that, Shirish.
So again, we'll clarify, not 2 to 3. We're saying 3 to 4 years over here. And then again, the current year pace of expansion demonstrates that particular ability. So if you see how many stores are opened in current year, if you're able to do that continuously with slight amount of acceleration on that current level, we should reach there easily.
I got that. What I wanted to understand now, your balance sheet is also healthy, and if there is a market opportunity, is there a thought process which you will fast forward this? And a related question on that: when we open a store, at any given point of time, how many stores or locations we have in mind, and we work parallelly?
So again, yes, nothing stops us from fast forwarding, or nothing stops us probably even, in fact, it requires slowing down. So, and this has been the way of Saphhire way of operating. Initially, if you see over last 3 or 4 years, before we got the model right, the economic model right, the payback right, we were slow in our expansion. Nothing stopped us from expanding then, but we said we will have to have a profitable growth. Now that we are comfortable with both the models, with the payback of 3.5 years kind of for Pizza Hut and KFC, we are comfortable with that model and we have increased the pace of expansion. Yes, if we are able to increase the pace of expansion and still continue to deliver on profits, yes, of course we can grow faster and higher as well. In terms of the pipeline and the property, the way we look at it, whatever our targets for the year is, typically we work on 4x that number in terms of trade area availability. Trade area is defined in terms of what our ideal trade area would be in terms of retail development over there, the size of the population, the per capita income, the propensity of income. So those factors are taken into account, and what are the ones which we categorize as the perfect location for us to open. So we typically work on 4x the number in a particular year to deliver 20, and if we can convert 25% of those, we are able to hit the targets.
Wonderful. Thank you. My second question is on, we did hear, and I know Sanjay's brain works very fast, and this 7-minute express, what you have launched, how does it work? I mean, does it increase the footfall in the store, or does it give you a better margin? And the related question is that how many cities we have rolled out this express delivery?
Yeah. So it's a simple operational, simple in the sense, simple to understand operational initiative. One of the things that we wanted to do in a quick service restaurant industry that we operate, how can we serve the consumers as quickly as possible with hot food? And therefore this initiative that, from the end of the billing cycle, within 7 minutes we will give you your entire order. If we don't give it to you in 7 minutes, then you have a free piece of chicken that we give you. I think, and we encourage our store staff to actually call out if there has been any, if we've indeed exceeded the 7 minutes. So the idea behind this, the consumer insight is quite simple, that if we deliver better service, it drives better affinity towards the brand, and hence over the long run it will help us in our same-store sales growth. This has been launched right across the country. So our stores and our sister franchisee stores. This has been launched right across, and we monitor at a store level what is the level of what kind of delivery against this promise we are able to fulfill.
And this is completely technology enabled, so that the 7 minute is not somebody's view or opinion. This is completely technology driven end to end, and it is but rolled out pan India across all our territories.
Okay. My last question, I'm referring slide 14 on KFC. What we see here, and it is purely my observation, that as you said, if the delivery comes back, I don't know why you're giving a very limited guidance, but if delivery is going to be remaining at where we are, and if we see that dining is going to be better, the margin should improve technically.
What do you mean by delivery coming back?
You meant dining coming back.
Sorry, not delivery, dining coming back.
Yeah. Yeah. So what is exactly the question? So you are saying dining holds back, the delivery holds back, and dining comes back strongly. So what are you referring to or inferring to?
I'm saying with dining coming back, with pre-COVID level, we were at almost 61%. And once things normalize, and I'm sure when mobility improves, dining will also improve. Now, if dining hypothetically comes or exceeds 60%, then technically your margin should improve from this level.
Yeah, so the first way to look that would be not to look in terms of mix percentage. So mix is always a function of how each channel performs. So right now the way to look at it is dining is at 80%. Yes, you are right. If this 80% goes back to pre-COVID levels, or it starts overachieving compared to pre-COVID levels, and we hold on to the delivery and dining, yes, there is a possibility of higher margin and throughput, but we will not like to get into those specific numbers over here. But yes, that possibility.
I'm not arguing on that. My personal experience that when we do dine in, the ticket size goes up, there is a mix also improves drastically, while takeaway is a very limited option.
So ticket price doesn't go up.
What happens is that we save on the delivery cost, so dining as a channel is more profitable, and that's the reason the entire bullishness and excitement we have on the omni-channel side. So yes, you're right. If the dining comes back fully and we hold on to the delivery and takeaway, yes, the margins will expand.
Thank you. I would request Mr. Pardeshi to rejoin the queue for follow-up question, as there are several others waiting for their turn as well. Thank you. The next question is from the line of Runjhun Jain from Nirmal Bang. Sorry, we lost your line. We'll move to the next question, which is from the line of Ankita Baheti from NewQuest. Please go ahead.
Hi, thanks. Thanks. Also, first up, I think
is not very clear. Can you please speak on the handset mode? There's an echo from your line.
Right, is this better?
No, ma'am. Please come on the handset mode and ask your question. Thank you.
Got it. So first up, I think congratulations to both Sanjay and Vijay for a really great quarter. I essentially have two questions. First, I think around Pizza Hut, and apologies if this has already been.
You, Ankita.
Ankita, we lost you. Your audio is not clear. I would request you to please check your phone line and rejoin the queue. In the meanwhile, we'll take the next question. The next question is from the line of Vinayak Mohta from Stallion Asset. Please go ahead.
Yeah, hi. Good evening. Congratulations on a great set of numbers. So I just wanted to, I had a couple of questions. So first one, you're broadly looking at a 18 to 24% store CAGR, the number of stores, with a 6 to 7% SSG. So can we assume that you have the potential to grow at the rate of 25 to 30% for the next 3 to 4 years while you're able to maintain the 8 to 10% PAT margins, assuming the incentive cost and certain amount of margin expansion that might come through, assuming that the dine-in recovers to pre-COVID levels from the current 70-80%?
Again, previously we have said, and we'll reiterate that as a management, as a company, we would be comfortable with a 25% CAGR on a revenue over a 3 to 4 years horizon. Yes, there could be years where we deliver maybe even 40% CAGR, but there could be a year with a 15% as well. So a 3-year, 4-year horizon with a 25% CAGR would be reasonable to assume. And at the same time, while I'll not comment on the PAT specifically, but at a EBITDA level, we would love to go faster through margin efficiency. So that should be in the range of 30 to 35% growth CAGR for EBITDA over 3 to 4 years.
Understood. So on this front, right now, after a very long time, you've got the unit economics right on both the brands. So just wanted to understand what is the kind of risks that you see to these, unit economics that you have built in. And also just wanted to add to this that can you also just explain once on the geographical diversification like bifurcation when it comes to you and your sister brand? Because in general, you've seen that there's a relative advantage in opening an omni-channel store, and there are certain advantages in opening a delivery store as well. So how do you plan on, given that you have relatively limited access to the geographical location, how do you plan on to getting the better of your sister brand in that sense, I would say?
So on first part, that getting the unit economics right is again, probably you would have seen in the quarter 3 results, because this is the one quarter where we have seen the least amount of COVID disruptions, and previously we have not been publishing quarterly numbers, and all our numbers got probably kind of diluted when you report the annual numbers during the RHP and DRHP. So this is not the current quarter phenomena in a way. We brought it out even previously that H2 of last year, Q3 and Q4, we hit really good numbers on KFC as well as Pizza Hut. And so was the case even during quarter 2 of this year and now in quarter 3. So yes, the improvements are sustainable, and again, the journey has not been just over the last 12 months, the journey has been over the last 24 to 30 months, where slowly we have been chipping at every 200, 300 basis points almost every year to get the model in place. So it's not just a quarter phenomenon. On the second part of the query, that how do you align in terms of the geographical distribution? If you actually go to slide number 8, that gives you the current geography where we operate. So in KFC, there is a clear distinction. We operate in 10 states. Those are clear and distinct from what the other sister franchisees operate. These 10 states contribute roughly 56% of India's GDP. In Pizza Hut, there are 2 formats. Omni-channel format, we operate in 11 states. It's a clear and distinct rights which we have. These 11 states, they contribute 57% of India's GDP. On Pizza Hut delivery format, we have rights only in Tamil Nadu, but in spite of having the rights in Tamil Nadu, we don't operate that particular model because we don't believe in that model. We believe in the omni-channel model, simply because, and if I can just give you some elaboration over here, the size of an omni-channel store is typically 10 to 15% higher. It leads to maybe a 20% higher capex, but it delivers a 30% higher ADS levels, which gives us the potential to deliver even higher profitability. And that's the reason why we don't open a PhD format stores even in a state like Tamil Nadu where we have the right. And this has been a very simple learning for us from our Sri Lanka business, which has been doing really well over several years, delivering EBITDA margins, restaurant EBITDA margins close to 20%. And Saphhire was the first one to open this omni-channel format in the country while we inherited dining focus stores. Our focus was on omni-channel, and not just omni-channel, we went tighter and tighter and more compact. And now that we have cracked this model, we are quite confident about it going forward.
Understood. Just a continuation on this, it would be fair to assume that given the capex, like your sister brand has a capex of 1.2 crores on a blended basis, So you mentioned that, you have a capex of relative 20% higher. So your capex would be somewhere in the range of 1.4 to 1.5. And also, would that include the 40 lakh number that you have to pay to Yum Brands as a royalty per store or something?
See, again, we would not like to get into comparisons on specific number over here. When you say blended, what do you mean by blended?
Like across the brands, Pizza Hut, KFC, and for you it would be Sri Lanka combined.
Look at things when you blend it. See, KFC typically ranges anywhere between 1.7 to 1.9 crore rupees. Pizza Hut for us would range anywhere between 1.3 to 1.5 crore rupees.
So this would include any store opening fees as well that you have to pay to Yum?
No, so this would not include any store opening fees which you would pay.
So that is additionally on top of this?
Again, so just to add clarification to that, so while this will not include any store opening fees which we pay to Yum, pursuant to our development agreements, there would be partial or full waivers on initial fees as well.
Okay, and what is that banked on? Can you elaborate on that? On what basis do they?
Number of stores target in a particular calendar year.
Okay, and if you're not able to achieve that, then what do you pay?
Sorry?
If you're not able to achieve the target, then what do you pay as a store opening fee or any, however you would deem it?
Amount is a confidential number, so we'll not be able to give out the specific number on that particular side.
Understood. Let's do one last question. Can you please tell me when do we start paying tax and how much is the amount of tax losses that we are carrying on the books?
See, we have enough and more tax losses on the book, both from a depreciation loss point of view and the business loss point of view. And depreciation loss would be available to us on a perpetual basis. The business loss would be on a basis for next 7 years from the year when you incur those losses. We don't expect to pay the taxes maybe a year later on a MAT, but again MAT is adjustable. So in a real tax sense, may not be for next 3 to 4 years.
Understood. Great. Thank you so much for all the clarifications and all the best.
Thank you so much.
Thank you. The next question is from the line of Ankita Baheti from New Quest. Please go ahead.
Thank you.
We lost you.
Yeah. Apologies about that. So first up, congratulations on a great quarter. I think my limited question was on Pizza Hut. You mentioned that you've rolled out omni-channel successfully in a couple of stores, most of your stores since 2019, and on a blended basis, your ADS is at 64. So just if I had to understand, if you have a broad estimate of where your omni-channel focused stores are operating at, I'm assuming their ADS is possibly higher than 64. So just in terms of potential, where do you think that this can ideally reach if you were doing omni-channel across, say, for example, Pizza Hut?
Yeah, so on a 64 basis, I would say that the spread would be perhaps plus 10-15% here and there. That's it.
Got it. And so essentially you're saying that some of your omni-channel stores might be closer to, say, 70-75 also.
No, so our oldest stores, from a revenue perspective, actually even 10-15% is too high. Might be perhaps 7 to 8% higher. But because of their size, their profitability is slightly lower. I would say that the omni-channel stores are also delivering 64 or thereabouts.
So the impact is not because of omni-channel or large size. The impact when you see a lower ADS is because of the stage in which the store is, So typically when you open a new store, it starts at 20% lower than the brand average. That's what we are seeing. And over a 2 or 3 period time, it comes to the brand average level. But again, the brand average increases by then because you continue to see SSG even in old stores. So that's the way to look at it. There is no distinction between an old store or an omni-channel store in terms of its ability to deliver the throughput. If an omni-channel store is mature enough, it will deliver the brand average.
Understand. No, that's helpful. That's a limited question from my side.
Thank you.
I think we have the last 2 questions to go. Yeah. Margaret?
So should we proceed with those, sir?
Yeah, the last 2 questions we'll take.
Thank you. The next question is from the line of Srinivas from Rockford Consultancy. Please go ahead.
Congratulations, sir, for excellent set of numbers. I have only one question. What is your store expansion plan in Tier 2 and Tier 3 cities? And what would be the payback period in those?
Yeah, I think the specific numbers I would not have at this moment, Srinivas, but I'll just give you a broad overview of how we look at expansion. Expansion occurs in three buckets. In the largest cities, for example, Mumbai or Delhi or Chennai, we are increasing the density of stores. So if I look at perhaps a couple of years ago, the gap between a store would have been 7-8 kilometers. That is starting to shrink. It might be 3 to 4 kilometers, and in some cases even less. So there is increased density in the largest cities. In the Tier 2 and Tier 3 cities, where the first store has done very well, we have opened a second, and if the second store also does well, we open a third and fourth. And then finally, we are entering into new cities. So it's so in cities that we are present in, we are increasing density, and then there are new city launches also.
So typically, again, I don't have a right now exact number, but typically 75 to 80% new store additions happens in the places where we are already there. 20 to 25% we go into the new areas, new cities.
Okay, that's good. And what is the conservative expansion numbers you can give in 1 year?
We will avoid giving 1 year guidance, Srinivas. I think our business is, and India is a market where we need to look at it over a medium term, and therefore what we said, double the store count in a 3 to 4 year time horizon is what we will stick to.
Okay, thank you very much.
Thank you. Ladies and gentlemen, due to time constraints, it was the last question for today. I now hand the conference over to Mr. Sanjay Purohit for closing comments.
Yeah, thank you everybody, like I said, for joining our first ever financial results conference call. Thank you for supporting the company during our IPO process. We've had a really good quarter. I mean, if anyone were to wish for the first ever financial results to be presented in this manner, perhaps this is it. So we're quite happy delivering our best ever sales, EBITDA margins, and PAT margins, and store additions. And I think going forward, we hope to have a long, productive relationship together. So thank you very much. Stay safe, stay healthy. God bless.
Thank you, folks. Thank you.
Thank you. On behalf of Saphhire Foods India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.